So let's start by talking about the budgeting process. Managers have to ensure that the activities of employees and departments contribute to meeting the company's overall goals. So, budgeting is the process of planning future business actions and expressing them as formal plans to help achieve a coordinated effort. A budget is a formal statement of a company's plans expressed in dollars. Unlike long term strategic plans, budgets typically cover shorter periods, such as a month, quarter, or a year. Budgets are useful in controlling operations, and the budgetary control process involves four key steps. Step one, we develop the budget from planned objectives. Step two, we're going to compare the actual results to budgeted amounts and evaluate the differences. And three, we're going to take corrective and strategic actions. And lastly, step four, we are going to establish new objectives and a new budget. So let's talk about the benefits of budgeting. Budgets benefit the core managerial accounting functions of planning and controlling. From a planning perspective, a budget focuses on future opportunities and threats to the organization. This focus on the future is important because the daily pressures of operating an organization can divert management's attention from planning. So, budgeting forces managers to plan for the future. Controlling. The control function requires management to evaluate or benchmark operations against some operating norm. Now, because budgeted performance considers company, industry, and economic factors, a comparison of actual to budgeted performance provides an effective monitoring and control system. And that comparison can assist management in identifying problems and taking corrective actions that may be necessary. Coordinating. Budgeting helps to coordinate activities so that all employees and departments understand and work toward the company's overall goals. Communication. Written budgets effectively communicate management's specific action plans to all employees. When plans are not written down, conversations can lead to uncertainty and confusion among employees. And lastly, motivation. Budgets can be used to motivate employees. Budgeted performance levels can provide goals for employees to attain or even exceed. Many companies provide incentives like cash bonuses for employee performance that meets or exceeds those budgeted goals. The budgeting time period is usually tied to the company's fiscal year, which may or may not be the same as a calendar year. Each company can determine their own fiscal reporting year. So, to help control operations, the annual budget is normally separated into quarterly or monthly budget. And the short term budgets allow management to periodically evaluate performance and take corrective action if necessary. Many companies also use a continuous budgeting process by preparing rolling budgets. In a continuous budgeting process, a company will continually revise their budgets as time passes. With a rolling budget, a company revises its entire set of budgets by adding a new quarterly budget to replace the quarter that just lapsed. So basically, at any point in time, monthly or quarterly budgets are available for at least the next 12 months or quarters. As one time period passes, we budget another time period out. Okay. This week, you're going to learn to prepare a master budget for a manufacturing company. Now, in your book, you'll also learn how this master budget process can apply to a merchandising company or even a service company. The most complicated, though, is a manufacturer. So we're going to primarily focus on preparing the budget for a manufacturer, And then if needed, you can always simplify the process for one of the other company types. But we're going to look at the key operating budgets. That's going to be the sales budget, the production budget. From the production budget, we can create a direct materials budget, a direct labor budget, a factory overhead budget, and also a budget for our selling and general administrative expenses. In terms of financial budgets, we're going to focus on the cash budget, and we'll also put together a budget for capital expenditures. Now, the most important thing that I want to draw your attention to here is that the sales budget is on top, and that is absolutely critical because the sales budget will drive all of the other budgets. All of the other budgets are going to be based on that sales forecast. And for that reason, management wants to make sure that that sales forecast is just as well informed and realistic as possible because it will drive the other budgets. Now, we'll just look at a few components of some of the other budgets. So after we prepare our sales budget, we're ready to prepare the production budget. Now, one thing that I want to emphasize is that the production budget is always stated in units rather than dollars. We are calculating the number of units that we need to produce. And this is significant because it's that unit that is going to drive our budget for direct materials and direct labor. So when we're doing the production budget, we are only calculating in units. Okay. So let's look at the simple approach for computing our required production, the units that we need to produce in a given accounting period. Okay, again, budgeted sales are going to drive everything. Okay, so the required units for a given period is going to be the budgeted sales, how many we think we're going to sell for this period, plus our budgeted ending inventory, okay? And we want to have something here. It doesn't have to be a lot. It's going to depend on the company. They can decide what sort of cushion that they want to have in ending inventory. And you may automatically think, well, we want to sell everything, right? We don't want anything in ending inventory. But you don't want to sell everything. You want to have something in ending inventory because otherwise, what can happen is if there's a little hiccup in your supply chain, you could find yourself in a situation where customers are placing orders and you don't have the product to fulfill those orders. And we all know that if we can't meet customer demand, they might, go to another supplier who can meet their demands, and we could lose a good customer. So generally speaking, we don't want to completely deplete our inventory. So we want to have some ending inventory on hand. A lot of companies will base it on some percentage of the next quarter sales or something along those lines. But it's up to each company to decide how they want to do that. But so basically, we take whatever we want to have left in ending inventory and add whatever we think we're going to sell. That tells us how many we need for the period. We subtract out whatever we start with in beginning inventory, and the difference represents how many we are going to have to manufacture for that particular accounting period. Okay. Now, again, the production budget is what is going to drive the direct materials budget and the direct labor budget. Okay. Based on the number of units of a good we're going to produce, we have to look at the amount of materials that's required per unit. For example, we're going to produce one finished good of a unit. Maybe we need 4 pounds of material, or 3 feet of material, depending on what the product is. But basically, we're going to look at the number of units we're going to produce, multiply it by however many materials we need per unit. That gives us our needs. We're going to add our desired ending inventory. And similar to the previous logic, we don't want to completely deplete our inventory. We want to have something left in there. So we're going to add that, subtract what we had to begin with. That tells us what we need to purchase for the period. Direct labor, again, this is going to be driven by the production budget. So we know how many we're going to produce. We multiply that by the number of labor hours required per unit, and then we multiply that by the direct labor cost per hour. And that tells us how much we are planning to spend on direct labor. Okay. Now I'm going to hop over and talk about the cash budget for a second, because I can tell you of all of the budgets, the cash budget has a tendency to be the most challenging to prepare. The cash budget really looks at the timing of our expected cash receipts and cash payments. So that means we have to think about the timing of how our accounts receivable are going to be collected, the timing of how we're going to pay for our accounts payable, and whether we're going to require any short-term financing. If our cash balance falls below our minimum desired cash balance, we may have to increase our short-term financing. If we fall above the minimum, maybe we can repay some of that short-term financing. A lot of companies will use something along the lines of like a line of, a revolving line of credit that they can kind of tap into from month to month if they need to pad that cash balance a little bit.